Hi, Professor. So today I will be presenting my final project for the financial accounting class about PepsiCo and its financial ratio analysis. So let's get started. So before we get into the details of financial ratio analysis, I would like to give a proper introduction about the company itself, because it's one of the best known companies worldwide. So why not start with a good introduction about the company? So PepsiCo is one of the world's leading global food and beverage companies, and it has a very powerful and diverse portfolio of brands. Most of them we already know about, including Pepsi, Doritos, Cheetos, and Lay's. So it was founded in 1919, and now its headquarters is located in New York. So PepsiCo operates in more than 200 countries and territories. And the company is organized into seven reportable segments, such as Frito-Lay North America, PepsiCo Beverages North America, and international regions like Europe, Latin America, and Asia Pacific. And each one of these segments plays a critical role in delivering a wide array of convenient foods and beverages to global consumers. So let's continue with a little bit more introduction about the company. So in 2024, PepsiCo employed over 319,000 people globally, which is a very big number, and achieved a consolidated net revenue of $91.9 billion and led by strong performances in its beverage and snack divisions. So the company continues to innovate in different areas, and its main focus is on healthier products, sustainable packaging, and emerging technologies like artificial intelligence to enhance its global operations. And as we know, artificial intelligence is being used in lots of different areas nowadays because the companies are trying to, achieve more efficiency by spending less time or energy on certain business operations. So PepsiCo's success is built on world-class distribution systems, iconic brand loyalty, and commitment to adapting to consumers' trends in health, convenience, and sustainability. So before we start analyzing anything about the company, we have to know about the company's values first. For PepsiCo, these values include diversity, equity, inclusion, integrity, speaking truthfully, and respecting other people. In this way, PepsiCo tries to create a more representative workforce and a one that is more equitable. At the same time, PepsiCo has reinforced its commitment to ESG principles, which are environmental, social, and governance principles. But Pepsi also has a much bigger goal, which is to reduce its emissions to net zero by 2040. So PepsiCo tries to commit itself to both social and environmental contribution while also making profits. Now let's move on to the analysis part of the presentation. Well, we have 21 ratios in total. That's why I will try to go through each one of them as quickly as possible. I will start with liquidity ratios first, which include working capital, asset test ratio, and current ratio. A short definition of a liquidity ratio would be a type of financial ratio that is used to determine a company's ability to pay its short-term debt obligations. On the right part of the screen, you can see the graph for working capital. However, on the left part, I have highlighted some key information, which includes consistently negative working capital. In all 5 years, working capital for PepsiCo have been negative, a sharp decline in 2021 and 2022. There's a slight recovery next year, but it hit its lowest point in 2024 across the 5-year period. So why the working capital for PepsiCo is negative? There are a few reasons for that. It includes reliance on large short-term obligations to finance its operations and boost returns. At the same time, it pays a lot of dividends. It has aggressive shareholder returns, and that's why it has less cash and therefore less working capital. There's strong supply chain bargaining power that PepsiCo has, and that's why it pay its payments very late to its suppliers. And there's continued capital investments, high turnover inventory model, which means low levels of current assets are maintained intentionally. So I will not talk about current ratio trends because it's very similar to working capital. We need to save time for other slides. So I want to summarize current ratio. PepsiCo consistently operated below 1 current ratio over the 5-year period, which reflects a deliberate working capital strategy focused on efficiency, strong cash flows, and extended supplier terms rather than accumulating excess current assets. So for asset test ratio, again, the trends are very similar to working capital and current ratios trends. The only difference is that there was a slight increase from 2021 to 2022, whereas in working capital and current ratio, in that year, there was a slight decrease. Let's summarize. PepsiCo's asset test ratio stayed below 1 for 5 years. Again, it shows that the company kept only a small amount of cash and easily convertible assets on hand. Instead, it relied on steady cash flow and strong supplier relationships to manage its short-term obligations. I will now start talking about efficiency ratios, which include accounts receivable turnover, average collection period, inventory turnover ratio, average sale period, operating cycle, and total asset turnover. Efficiency ratios are metrics that are used in analyzing a company's ability to effectively employ its resources, such as capital and assets, to produce income. So when we look at the accounts receivable turnover graph, we can see that there was an increase from 2020 to 2021 from 8.67 to 9.30, and there's a steady decrease by 2023. And by 2024, we can see that accounts receivable turnover has almost returned back to its previous levels, which it was back in 2020. So PepsiCo maintains, like overall it maintains strong control over customer collections throughout the period. Now, let's have a look at the average collection period. So, some key highlights from the graph is that in 2020, it started at 42.08 days, meaning it took around 42 days to collect payments. In 2021, it improved to 39.23 days, showing faster collections from customers. And then in 2022, there was a slight increase, but then there was a jump to 41.85 in 2023. And in 2024, it slightly priced again, so it was nearly back to the 2020 level. So PepsiCo's collection period tightened in 2021, 2022, but then widened again in the following years, suggesting that customers took longer to pay. Now, let's talk about the inventory turnover ratio. So, some key highlights from the graph include in 2020, started at 8.47, showing strong inventory movement. In 2021, it reached its highest point at 8.70, indicating very efficient inventory usage. In 2022, there was a slight decline, but it was still healthy. And then in 2023, dropped to 7.93, suggesting slower sales or higher inventory levels. And by 2024, it fell slightly again to 7.85, continuing the downward trend. So PepsiCo's inventory turnover was strong early on, but since then it has gradually declined. So when we look at the average sale period, we can see that like in 2020, it started at around 43 days, and then we can see that it slightly increases by 2022, but there was a sudden jump by 2024, which peaked at 46.52 days, which was the longest time that it took to sell inventory during that 5-year period. So PepsiCo's inventory moved more quickly in the earlier years, but starting in 2022, the average time to sell products increased. So this may suggest that there was a buildup in inventory or slower rates growth in more recent years. So when we look at the operating cycle of PepsiCo, we can see that there's an upward trend from 2020 till 2024. So it started at 1.02 in 2020, and it increased to 1.11 in 2024. So it means it took more time to sell products and collect payments, possibly due to higher inventory levels or slower customer payments, or both of them. So it was considered efficient still, but this trend may reflect that there were some shifts in operational speed or demand. So when we look at the total asset turnover graph, we can see that an upward trend started in 2020 and it continued until 2023, which meant PepsiCo steadily improved its ability to generate revenue from its asset base during those years. However, there was a slight decrease from 2023 to 2024. And despite that slight dip in 2024, we can say that Overall, PepsiCo was able to, keep its efficiency across the 5-year period. Now, we are moving on to solvency ratios, which include times interest earned, debt to equity ratio, and equity multiplier. So, a solvency ratio is a performance metric that helps us examine a company's financial health. In particular, it enables us to determine whether the company can meet its financial obligations in the long term. In times interest earned graph, we can see that in 2020 it started at 8.05, but then it's sharply decreased to 5.61. Then there was a big increase in 2022 to around 10. However, by 2024, we can see that times interest earned ratio went back to its 2020 levels, around 8. So PepsiCo generally kept strong earnings to cover its interest costs, and the 2021 dip was actually due to higher interest expenses despite rising profits. So when we look at the debt to equity ratio graph, we can see that its highest point was in 2020 at 5.86, but then there was a steady decrease by 2022, and then it increased slightly again to 4.47 in 2024. However, it was still much lower than its 2020 level. So PepsiCo significantly reduced its debt burden after 2020. While there's a minor upward trend in the last 2 years, the company has actually maintained a more balanced use of debt and equity compared to earlier years. So in the equity multiplier graph, we can see that in 2020, 2021, the values were above 6.2 on average, and it indicated strong financial leverage. By 2022, there was a sharp decline to 5.19, reflecting a shift in PepsiCo's financial profile. And around 2023 and 2024, it stabilized around 5.3 to 5.4, which suggested a more consistent capital structure. And that drop in 2022 was actually due to strong earnings performance, which improved PepsiCo's ability to fund its operations without increasing its leverage. It is time to move on to the profitability ratios, which include gross margin percentage, net profit margin percentage, return on total assets, return on equity, earnings per share. So, profitability ratios are financial metrics used by analysts and investors to measure and evaluate the ability of a company to generate income relative to revenue, balance sheet assets, operating costs, and shareholders' equity during a specific period of time. And they show how well a company utilizes its assets to produce profit and value to its shareholders. So in gross margin percentage, we can see that in 2020 it started very strong at 54.82%. However, there was a decrease in both 2021 and 2022, and then by 2023, it increased actually. It almost got back to its previous levels in 2021. There was a slight decrease in 2024, but we can say that PepsiCo actually very successfully regained its ground by 2023. And the main reasons were probably its pricing power and operational efficiency. So when we look at the net profit margin percentage graph, we can see that there were a lot of fluctuations. However, I wouldn't say that the changes were too big. So it started at 10% in 2020. It showed solid profitability. And when we look at all years, we can see that the value stayed above 10 and just below 11, except for 2021. And there was a slight decrease in 2021 to 9.7%, and it peaked in 2024. So overall, PepsiCo maintained stable and improving profitability after 2021. So the company's strong brand and pricing strategies also helped it, of course. And despite macroeconomic difficulties, it performed quite well. So when we look at the return on total assets, we can see that there is an upward trend um, uh, that is more dominant, except for the 2023 year, because in 2023 there was a very slight decrease. However, generally it looks very good, and PepsiCo consistently improved its asset efficiency over the 5-year period, which signaled a very strong operational performance and return generation. So when we look at the earnings per share graph, we can see that there's an upward trend throughout the 5-year period, and there are some key highlights that I would like to mention. So in 2022, it marked a significant jump from 5.56 to 6.51, and this growth was actually driven by a few reasons, including 8.7 increase in net revenue, supported by higher pricing and favorable product mix, and improved operating profit, slight decline in share count, which also boosted EPS further. And in 2023, 2024, there was a continued steady growth, although it was at a slower pace, which also boosted earnings per share. So we can see that the upward trend highlights PepsiCo's ability to consistently deliver higher value per share to investors. Now, let's talk about the final batch of financial ratios, which are market value ratios, which include price to earnings ratio, dividend payout ratio, dividend yield ratio, and book value per share. So, market value ratios are used to evaluate the current share price of a publicly held company. So, these ratios are employed by current and potential investors to determine whether a company shares are overpriced or underpriced. So as you can see in price to earnings ratio graph, there is some increase from 2020 to 2021. However, the dominant trend is downward trend, which continues from 2021 till 2024. So the falling PE ratio reflects a disconnect between rising earnings and market valuation, and it's possibly due to external market pressures, which includes investor caution or shifts in sentiment. When we look at the dividend payout ratio graph, we can see one thing that immediately stands out, which is the sharp decline from 78 in 2020 to almost 70 in 2022. And that dip in 2022 actually indicates a more conservative payout strategy, which aligned with PepsiCo's strong earnings that year. And in 2023 and 2024, it actually recovered to over 76%, returning closer to its historical levels, which means that PepsiCo, has a continuous commitment to rewarding its shareholders. So when we look at the dividend yield ratio, we can see that there is a decrease from 2020 to 2021. Around 2022, it's almost the same as 2021. So there's no, significant changes. But then starting from 2022 until 2024, there's quite a lot of increase. And the rising trend in 2023 and 2024 actually might suggest that PepsiCo's dividend became more attractive to investors. It could be either due to increased dividend payments or a decline in share price. So now let's have a look at book value per share, which is our last financial ratio. So key highlights here is that from 2020 to 2023, there's a steady annual growth, which ends at 13.47. There's a slight decrease in 2024, but it is not very important. So the slight drop in 2024 was actually due to a decrease in total shareholders' equity, while the number of shares remained unchanged. I also have included a quick competitor analysis because one of my classmates had Coca-Cola, so I thought it would be interesting to compare the two because they are very, well-known competitors. So let's have a look at the analysis. So in terms of liquidity and efficiency, Coca-Cola has stronger short-term liquidity with a current ratio of 1.0 3 versus PepsiCo's 0.82. However, PepsiCo outperforms on inventory and asset efficiency with higher inventory turnover, 7.85 versus 4.0, and total asset turnover, 0.92 versus 0.48. Next on, let's compare the profitability ratios for these two companies. Coca-Cola's net profit margin is significantly higher, 23%, showing greater bottom line efficiency. And PepsiCo leads in EPS, earnings per share, which is 6.72 for PepsiCo versus 2.49 for Coca-Cola, signaling stronger earnings per shareholder. Now let's continue with returns to investors for both companies. So PepsiCo shows a slightly higher dividend yield, which is 3.49%, and return on equity, 50.94%, reflecting strong shareholder returns. Coca-Cola's price to earnings ratio, which is 25.2, is higher, suggesting a premium valuation by the market. So overall, we can say that Coca-Cola excels in profitability margins and liquidity, whereas PepsiCo leads in operational efficiency, earnings growth, and value for money dividends. This is the last slide of the entire presentation. Thank you so much for listening to my presentation, Professor. And you can find some important information about me on this last slide. And if you have any feedback about my presentation, I would love to hear about them. Thank you so much and have a lovely day.